The Hedgeless Horseman here. It's December the 21st. I guess it's technically the 20th still in North America. Um, First of all, thanks to the sponsors. Second of all, Merry Christmas and a Happy New Year. I haven't done a video in, I don't know, a week maybe or something. It's just been, yeah, I think you'll understand there's been a lot of stuff to take care of before, um, for Christmas celebrations and all that. And as always, like most of my time is spent just thinking about investing and looking up new cases, figuring out cases I own. I mean, obviously we've had pretty good times in the mining sector recently, and prices have gone up, and when you have big swings like that, something goes up 100%. I really would like there to be a, let's say, good reason to keep hodling such a story. If price only goes up without value actually going up, then it's just by default a bit of a worst case. Theoretically, it could still be the best case you have if something goes up 100% without news because it was that undervalued to begin with. But still, since I'm pretty much always all in, I have to. I think about what I own, how cheap they are versus other stuff I own that's cheap that I might wanting to value shuffle into, or if I'm lucky enough to find a new case that I simply think is at least cheaper than the least cheap case I already own, then I can sell that one or sell maybe some of the five least cheap and buy something that might be as cheap as them or something along those lines. I mean, that's why it's sometimes I feel like I need a vacation because it's. I mean, it's been 10 years now that I've been literally fully invested for, and also manage my a bunch of family portfolios and some portfolios for friends. It's just a lot to think about, and your brain is never really turned off. I mean, I do a lot of research and thinking at weekends and all that, and it's just, I'm happy I'm not into crypto. I don't believe in crypto, but to have the market open 24/7, I don't think that's going to increase the quality of life for anyone really. But yeah, I mean, that's at least one positive thing about being an investor. It's like I've had a few thank you messages from family members because their portfolios did quite well this year, and that's fun. I mean, investing is very much one of the few occupations you can have where you can actually share it. I mean, if I was a really good plumber, it's not like I could share that with family and friends or anybody listening to this, for example. I guess I could theoretically come and fix the plumbing if you have a problem or if they have a problem. But I mean, I focus on investing, and then the spillover effect is that I can literally also have take some family members' money and invest it as well. So they not that they necessarily would have exactly as the same returns as me, since I get I'm into placements and I do private deals and stuff like that. But it's fun because it doesn't add that much more work for me because I've already done all the work for myself, and then you can still influence people's lives hopefully for the better. With that said, I know a lot of people who don't. I mean, well, if somebody asks me, especially if they don't know investing or the sector, what should I be buying, I almost have no answer because, and that's why when people ask me on Twitter what should I be buying, etc., it's like I can't answer that for you. It's like I could, Or let's say, hey, I could easily answer it for you if I bought, let's say, a very liquid stock, and the way I make money is for somebody just to uh, pay up. I mean, that's of course pretty much pump and dump, because then it's like, well, my case is that you pay up for it. Well, when, let's say, oh, then I'm out after a 30% bump, and then you have no idea what you bought, and I bought it because I was going to get you to buy it up 30%. I mean, so obviously I don't want to be a guy like that. So that's the thing. It's like, not that I'm Mother Teresa, but I wanted, and that's why I didn't like poker actually. It's a zero sum game. It's like you take money from someone else. Sure, I mean they know the game, they know they're at the table and all that, but it's like nothing is created at all. And sure, anything we buy, somebody, especially if it's cheap and we like it, we buy it. Somebody sold that cheap stock and might miss out. But still, it's yeah. I mean, this is at least a bit more productive, I would say. And there's not necessarily an obvious loser. I mean, if somebody needs the money and they're selling a cheap stock and you're buying that, you're helping them out. If they need a roof to fix, need to fix a roof or whatever, or buy a washing machine and they're selling, it's like you're giving them liquidity by putting in a bid or hitting their ask or something like that. I mean, well, one can't be, I guess, too idealistic, because it's impossible. It's not like we're saving the world either by uh, buying cheap and trying to make some money. But still, I mean, the way you go about it, I think, matters quite a bit. And that's real. It's like I've tweeted that before, that you're probably much better off owning a good case that you know than a objectively great case that you don't have any conviction in. Like, you could give me, somebody told me, it's like, hey, buy this, whatever it is, it's the best thing ever. It's like, okay, how long is that conviction gonna last? Let's say it goes down 30%, and you don't hear from the person, right? And we're assuming this is whatever, a good guy, legitimate, friendly guy. But he's away for vacation for a month. I'm just making stuff up now, of course. I mean, it's not that easy to get away from the grid. But what are you gonna do? And let's say some other stock that you actually have conviction in, not as great of a case, but you have conviction in it, and you think it's a really good case, and that drops as well, and you're thinking, oh man, now that's cheap, and I know why I think it's cheap. You're probably gonna end up selling, the other case that went down, and buy the other one, and maybe that's a mistake. At least you bought something you think is good cheap. So I mean, it could obviously be worse. But my point is that you're not gonna have the correct impulse, in a sense, unless you just absolutely blindly trust someone that that, oh, this guy says it's gonna go, the stock's gonna go to $100, so and that's all you're working with, and it drops from $2 to $1, and you'll load up just thinking that. But it's like, realistically, if we forward the tape a bit and we have volatility, how often do we do smart stuff? I mean, I've sold a bunch of stuff cheap and low and regretted it later, where it's like the case didn't really change. Price went down. It was a boring stock, but the fundamentals were there, and it could be whatever. The news took longer than I thought, or it took longer than I thought for the market to actually care. And the usual, you hear people saying, opportunity cost, and almost nobody actually uses opportunity cost in the correct way. It's like everybody sees hindsight investing as opportunity cost. Well, it's not, but anyway. Going off a bit of a tangent here. I thought I would do this video not really about news, but kinda not copium either, because I mean things are going quite well in the market, and on average prices are going up, which all else equal is like less bargains. Obviously, if we could I would rather go back a year ago and buy those prices than today's prices. But I mean, I guess I still think we're way undervalued, and I'm going to get to that. Uh, but let's just think for a moment, like where are we right now? And I'm not using, I don't market time. I don't use whatever you would say. It's like, oh, it's up, so I gotta sell, or RSI of gold is that, or silver, or RSI of silver is yada yada, or the MACD looks dangerous, or I mean, I've literally been all in. It's like I suffered the downs, I've suffered ups. So I've caught the full brunt of every bear market since 2015, and also all the rallies, and including, I mean, the recent rally to today. But my strategy is like my strategy is intact, right? And I would say my strategy has gone more and more to a hodl focused approach. One reason is, of course, that since I'm getting a bigger audience than I had, let's say 7 years ago. 7 years ago, then it's like, okay, you can more easily, I guess, theoretically move stocks to bigger the audience. So then you have to be a bit careful, because like you never know who's following you. Um, and I mean, I've gotten messages from single moms and stuff asking about juniors, and I told them, it's like, you should probably not be in juniors. I remember one who said, I can't afford to lose 30% of my money. And it's like, if we're talking paper losses, that happens every 3 months pretty much in any junior in this sector. uh, so yeah, I'm trying to limit that, and I don't want to pump and dump. So it's like, then I have to be even more careful about picking, let's say, longer uh, term cases to, let's say, highlight that people can at least think about, because then that relieves the pressure of me as well, in terms of timing, in sense that I can't be anyone's portfolio manager, except if I literally have access to the portfolio. So it's then it's easier. Let's say you talk about a Lundin case or something, where it's like, I mean, since it's such an alpha play, typically it's like, yeah, the more time you hold that stock, the more you're probably going to be up. That's a pretty simple case. And you don't need to watch every news release or figure out what this what does this hole mean that they drilled at whatever spot. Whereas, like, if it's a high risk exploration case, then it's much more. I mean, those cases, and we've seen that recently, it's like they can be very volatile, and literally, the main case can get broken in basically one news release. Completely uh, different thing. But anyway, so with that said, it's like, where are we if we're just, I mean, I don't want to be in this sector if I can't find something cheap. Okay, and we know people have been calling tops, like, always. I mean, since forever, basically. If you look at gold here, I mean, people call tops here, top there, I mean, all the way up, basically. And then it's like, oh, it's overbought, it's gone vertical, yada yada, and just kept going. So my one thing, and I've talked about this before, is like, in a bear market, I do enjoy confirmation bias to the upside. And if I hold something cheap, I don't mind confirmation bias to the upside. But the point is, I want my portfolio to not be about the case, in my opinion, or I don't have any cases that are like, okay, gold is here, and I'm buying whatever gold junior miner because I think gold is going to go there. And if it doesn't, gold goes down there instead, I should lose, because the value of the company was fair at this gold price and then went down. That's speculation to me. Then you have to time it correctly. You have to know when the top is in, whatever, because all you're kind of subject to is the price of gold and sentiment, of course, for miners. And I can't possibly know any one of those. I mean, there's not many people who reliably, realistically can predict both of those. It's like Schrodinger's cat within Schrodinger's cat. As we saw here when gold hit the same price 4 times in a row, but juniors, for example, kept going down. So even if you thought, well, it's like, yeah, take when juniors were here. It's like, well, and somebody told you gold is going to be at 2,000 like 2 years later, you probably have lost money. So in that case, even knowing the future where gold was going, you would still have lost money if you bought juniors, gold juniors, because you wanted 3 times the leverage to the gold price. Gold went up, juniors probably went down. So, I mean, case in point in a sense, there's like, even if you know some of the stuff, that's what's literally going to happen, and you can still lose money because that's just how markets are. I much prefer to stack the odds in my favor that either they're super cheap right now, and or they're cheap and they're probably gonna get cheaper, or high risk, high reward plays where it's like there's no margin of safety really, but this looks good, and if they hit, if that becomes a success, it could go up 10 to 20x over the next 3 years or something, and pay for obviously X amount of losers in that case. So it's like I don't own any company because I think gold is gonna go up, or silver is gonna go up, or nickel is necessarily gonna go up. It's I want more than that. That also means though that we could get to that later. I might start off with, miners are enjoying record margins directly. So miners have gone up. This is GDX. Back here, the idea of this index ever going to all-time highs felt like, almost impossible. I mean, the pace is, a snail's pace. And then it's been gone like this. And make no mistake, this is a very abnormal return. A bull market, I mean, if this was, let's say, if you think this was really normal even in a bull market, at this pace, when is this, 2000? Okay, actually, I mean, the nominal prices are not that fat. Actually, I mean, 87, that's less than a double. I thought it would be even more. I mean, that depends. I guess this at least is, pretty, pretty bonkers. Yeah, maybe it's because it's major binary. So I mean, at the same time, I mean, if we think about very large companies, I mean, how S&P averages 9% per year over the long term. This would obviously be much more. This would be compounding at an extreme level. I mean, orders of magnitude more than the average S&P 500. But I guess the point is, and we can see this, excuse me, in this chart, even though it's only back to 2006. I mean, how many times has the GDX traded like this? It's pretty much the only time. It's gone literally. I mean, take this period for example. The only kind of equivalent was this, and that lasted for 4 months, and then it topped. 4 months, and then 3-year bear market pretty much. So make no mistake. I mean, if you think everything going vertical like this, like that's how a bull market is, and now we've been in a sense super spoiled. Especially the major miners have been super spoiled, and I don't know how cheap they are. I don't know how cheap Newmont or Agnico or Barrick is. I mean, I listened to Rick Rule recently where he said that the consensus estimates for earnings for the major miners, or he mentioned Agnico Eagle is done at like $3,200. That's what the estimates are based on, and obviously gold is like $4,300. So if that's the case, the earnings estimates are going to get beaten again, right? Because gold is much higher than what the analysts assumed it would be. So we could have this trading higher. And again, what I'm saying is that I don't know how cheap they are. I mean, are they pricing in $4,300 gold? Maybe they don't. But let's say they are fairly valued. That's why I don't really care much for GDX. I mean, if gold didn't go like gold has done, GDX wouldn't go like this, right? So if you knew where gold was gonna go and it would translate directly to profits, yes, you would probably make money. But even here, for example, I mean, it's like gold traded sideways here, and I think probably gold hit 2000 around this point, but GDX was still down. So there's still, sentiment as well. But what we can say, okay, GDX obviously looks like it kind of retested a breakout, and given that this is a 14-year consolidation, I guess one could say, I personally think there's a lot more upside, and we're gonna get to one reason why. But okay, GDX already rocking and rolling all-time high. Then we go down to GDXJ. I mean, I think the J stands for juniors, but I mean we know it's not proper juniors. It's just smaller producers basically. This one is not even at the 2011 all-time high. Well, the all-time high I guess was up there, but this looks like a pretty, let's say, important inflection point for traders. So in that case, I mean, there's quite some room here. This shows nothing about valuations. These could be more expensive than GDX simply because GDX destroyed more value, diluted the shares more, and all that. So it's like this doesn't factor in that at all. Theoretically, this might be the gold miners in GDXJ might be more expensive here than they were here. Theoretically, I don't think they are, but theoretically, this is just a chart. It doesn't, say how many, what's the dollar per margin is, or what the what's the NAV per share here versus here, etc. So you can't just look at, well, it's cheaper now because it's not this high. My point is that just at face value, it looks like the somewhat smaller producers, they're not rocking and rolling as much as GDX. And then when the next step is, I mean, the real junior space, and that's where I mostly spend my time. I mean, I haven't really been invested in producers in quite some time. Not really in a serious way, not in the public market. So I mean, the hodl folders, for example, they've underperformed GDXJ this year. GDXJ is up maybe, I think it's like 160%. I mean, abnormal, super abnormal return for a year. I mean, especially since you can just look at this time period here to there, and it's like, oh well, in 13 years it went down 81%, and then it's like, well, this year it's up 160%. Super abnormal, of course, and you can see this. I mean, this is again pretty much the strongest rally in this entire chart going back to 2009. So this is like, I mean, what they say, the biggest gains are, off the bottom, and then I guess when something goes supernova to the top, we could have a lot of grind in between. I mean, I've shown the chart of Huey from 2001 to 2008, for example. That's a bull market, and you can even say it's from 2001 to 2011. 80-90% of the time, the Huey was consolidating. Went like that, then zigzagged around for months or years even, and then it went like that and topped and zigzagged months, years, and maybe 10-15% of the time it actually went something like this, something like that. So this is abnormal. So don't kid yourself. I mean, a bull market, I've said this before and I've shown that. I mean, a bull market most of the time feels like a bear market, except that the surprises after the consolidation comes to the upside. So instead of here, for example, you have a this is obviously a bear market. It's like, okay, it goes down a lot, then it goes back up, and then it's still not until here where it actually drops, even lower. This was actually, this is a pretty brutal one, but here it's like it's grinding down, but it's like from here to here it's the same price, and this bottom basically held all the way here, so it's kind of consolidating counter trend rallies, and then it drops again, and then it uh, trades around. Or take this for example. When it dropped to this part, it kind of consolidated for 2 years almost, and then it dropped just a bit though and consolidated, but that turned out to be the bottom in this case. My point is, like, the rock and roll we've seen lately, even in a bull market, that's very rare. So I would just we could it could just keep going, of course, but I would be prepared. Assume that there's going to be much more boring days than good days, and even in an uptrend, half of the days might be red and all that. And how do you cope with that? If I was only in trading sardines, needing higher gold and silver prices, I would be anxious to say the least. Every day gold and silver goes up, and let's say miners goes up as well, I would be like celebrating. There's some paper profits, the account is worth more, and I'm hoping it's just going to continue. But the next day it goes down, and then I'm going to be scared that it's actually going to go down, because there's going to be plenty of people who are, the target price is always going to be whatever direction today was, basically, for tomorrow, of course. But if you have cases where it's like, this is where what you paid for something, or you paid here and it's priced there, but you think without the help of price of gold or silver, in 2 years I think it's going to be up there. Even if gold flatlines, you think the value is going to be up here. Then you have, a case. And even if gold goes down, maybe you think the price value is going to be here with a lower gold price. If gold went like that, you still think, given what the company might do over the next 2 years, it might be worth this much. That's much more alpha investing, and that's also why my type of investing, especially nowadays, doesn't really cater to these rips, in a sense, because I have few producers that directly benefit from higher price of gold, and it's been the producers that have rocked and rolled. But then if we go into some of the juniors, where it's like they don't earn money per se because gold is going up, because they're not in production, all that, it's hard nowadays to find a good proxy for juniors, because most juniors, since they're small and all that, they have a much easier time, and especially since they don't make any cash, they're much more prevalent to dilute their shares outstanding, which skews the share price as an indicator, in a sense, if you look back at long timelines. And of course also that some of them their cases might have changed a lot. Maybe they found 4 times the gold they had 6 years ago. All of a sudden it's a very different company, so it's hard to directly judge. I used to use Bear Creek Mining, but they acquired a mine that was kind of unprofitable, and they didn't go that well, and they raised a bunch of money. Interestingly now though, Highlander Silver is merging with Bear Creek Mining, which that was a surprise to me. And then it kind of got me thinking. If you look at Highlander Silver, because that's a Richard Wark Lundin play, magically they will almost always tend to go up. So Highlander Silver have done really well over the last 2 years. It's at like 600 or 700 million market cap, and they have a small resource right now. So without a tight share structure and Lundin's Richard Wark, put that project in run-of-the-mill junior management, and that would not be at that market cap. No way. Even though it might be a world-class project and all that, but there, in my opinion, is no way. And the funny thing then, of course, that it has performed so well in the bad times, because it went up not following gold or silver or whatever, but it's one of the few Lundin plays it's at. Now, when the metals have actually gone up quite a bit, that hasn't really followed. It's just been treading water, kind of. Why? I mean, it kind of makes sense. They don't necessarily directly benefit from higher gold and silver prices, and they were kind of a vehicle to play in a shitty sector environment. It was one of few that actually climbed higher, and people like Lundin, especially when you're scared or don't like the whatever, you're too scared to buy a run of the mill junior. And I mean, Lundins, they kind of manifest success one way or the others. But they acquired Bear Creek, which is kind of interesting. It's like, I wonder if one could see it as you know, I don't actually don't remember the specifics of the merger, but let's say Highlander Silver has kind of, you know, somewhat overvalued paper. It would make sense to buy a, you know, acquire something then, and you know, pay with paper. So if you have something that's, you know, you're kind of overvalued and you want to backstop the value, you acquire something that's much cheaper. So I mean, the existing shareholders then get a value bump per share. And it might be that they want to be the go-to silver play, because let's face it, the beauty, I guess, in a sense, with silver sector is that there's so few names. I mean, imagine there's like, you know, 50 series juniors or half series junior, whatever. Let's say you consolidated them down to 20 names. So if there's a real retail mania for silver juniors and it's like 20 names to choose from, well, you know, the entire flood is going to go into 20 names instead of getting spread out by a bunch of, and of course, the more, you know, executive teams, the more G&A and yada yada yada. So the burn rate is higher, the dilution is higher, all else equal. So it kind of makes sense. I don't know exactly. I mean, I don't remember the specifics of the Bear Creek Mining's large silver project that's been around for ages. That's why I used to use it as a proxy, because it didn't really change, and they diluted, but they didn't. I mean, they didn't go bankrupt and they didn't create that much value. So it was kind of their big silver assets that, yes, got gradually diluted, but in some way it kind of, you know, showed ups and downs of sentiment and all that. Now it's, since they acquired a mine, and you know, I think dilution ramped up, and yeah, so it kind of somewhat destroyed it, I would say, because it actually changed. But let's take Liberty Gold, for example. I mean, they're a developer, um, big project. I don't think it's changed that much over the last X years, since, let's say, 2020, except dilution, I guess. But that's way down here. I mean, all else equal, I'm assuming their produce will have grown, and the gold price has obviously gone up a lot, and still, share price is down here. I don't actually know, again, what the market cap was up here versus here, but assuming, yes, they've grown, let's say they haven't destroyed value, they've grown in size, and the gold price is up a lot, and still the share price is down here. So I mean, if it's like GDX all-time highs, GDXJ halfway to all-time highs, let's say a gold developer like this, not even halfway to the 2020 high. And Impact Silver, I don't know the fundamentals that well, and again, I don't want to look back too far, because again, dilution, all the, okay, apparently it froze. Anyway, you can see there's like treading water down here. I'm assuming a lot of dilution, maybe things haven't gone well, yada yada. Define Silver, been around for quite some time and hasn't changed that much, I would say. Uh, Far from the 2016 top, very far from the 2021 top. They have a lot of warrants and stuff out there. That's what I think is being churned through here, for example. But my point is that it's like, I have a junior focused, like real junior, like non revenue generating junior focus, which does not directly benefit from higher gold and silver prices. I mean, it doesn't show up in value at this very moment. I mean, if gold and silver prices go higher today, producers will get paid a bit more than they were yesterday, even though, to be fair, it's not like, yes, okay, they gold goes up 2%, they get 2% more revenue today than yesterday. That's just one day because gold can drop the same amount tomorrow. So at face value, it's just that literally what that means is that you get 2% more today than yesterday. And today is just 1 out of 365 days. So let's say the gold company goes up 10%. Does that make that much sense that literally the the intrinsic value of whatever miners, all assets, and for the next 20 years, what the company is going to do, etc., cash flows, went up 10%, yeah, went up 10% because they get 2% more on the gold sold today than yesterday? No, I mean, that's also ridiculous, right? So it's just degrees of ridiculousness, I guess. And yeah, and then we have like exploration, like proper grassroots exploration stocks, like Inflection. They haven't really diluted, and I was gonna say fundamentals have quite clearly improved from the last time the price was here. And I don't think the market. I mean, they did some raising. I think 2023, but like I think the market cap is almost the same. Copper is obviously higher. Gold is obviously higher. They're closer to a discovery than they were here. They have 3 times the land package. They have a. I don't remember when the deal with Anglo actually was put in place. Regardless, they're pretty much the same market cap. So you don't see any copper price enthusiasm. You don't see any gold price enthusiasm. It hasn't traded like GDX, for example, but they don't have a mine either. So again, understandable from that perspective. But I think it just goes to show where we are. I think we're quite early in the junior cycle still. Major miners, GDX, they're rocking and rolling. They're on people's radar. Newmont was the, I think, best or second best performing company on S&P or something. Until well, as of November, somewhere along those lines. So it's like I don't think institutions are totally asleep at the wheel. Then you go to GDXJ, which less capital can get into, seen as a bit more risky. Well, it's it's getting there. It's been having a hell of a rally from the bottom here, but it's not at all-time highs. And then we go to again some of the juniors. I mean, they have well, they're they're one, let's say 1/3 of the, maybe actually. I mean, with the dilution is hard to say, but let's say they're halfway to the enthusiasm that was seen in this sector at 2020. My point is that if you have a very junior focused portfolio without a bunch of producing juniors and without a bunch of, let's say, optionality play, low grade, huge resources, you're probably lagging the GDXJ. And that's kind of fine because I mean the point is that yeah, or yes, we can say it's like people say opportunity cost whatever, but from today, okay, we know what has happened in GDX. What if gold and silver prices stay flat for 2 years? What if they go up? What if they go down? I mean, how much risk reward is there? If you need gold to go higher, that's not much of a case per se. You can think and you can bet on gold going higher, etc. Whereas, like I think some juniors, for example, they're probably actually cheap. I think they're actually cheap. So it's like they probably should go up, but haven't gone up enough to close the fair value gap. GDXJ might have closed it or might be close to it, but for discussion's sake, let's say the major miners are the most fairly priced. They're the least cheap. Then smaller producers are maybe cheap still. And then if you go down to juniors or even junior producers, maybe they can kind of be cheap still. But this is what typically has happened for my portfolio and hodl folios, that I tend to underperform during the good times, because it is an all-weather approach. If I think they're gonna create value from finding ounces, for example, that's the main driver perhaps for that stock, and it's not what the gold price is going to do. If you write them both, you can have really good returns at the end of the day, of course. But it just, I mean, that's something you kind of have to swallow, I guess. That depending on your strategy, I mean, theoretically, the best one, and I know I talked about this, and I talked to other people about this, and some actually do that they when it get extremes, I mean, most people sell out of the sector, but some is like they're picking up producers set because they tend to move first. The bigger producers tend to move first. Then it trickles down basically. I have always had a hard time doing that because to me that's just yes, I know the sector is going to go up one day, but if I find producers somewhat fairly valued at a low gold price, and it's like, yes, if gold goes up a lot, they're gonna go up a lot because the margins will expand. That's still, in a sense, somewhat speculation to me. Where if I see something that's like, I think this is 200% undervalued, I have a hard time selling that to buy something I don't even think is undervalued, but where the idea is that, well, when gold and silver, this gold and silver cycle turns up, they're gonna go up the fastest. Sure, yes, but they also suck for a big period of time. If we're talking longer term, my portfolio outperforms GDX, but in times like we've seen in the recent past, it underperforms it. Then if we go to the, a blow off top when these, let's say, it does in fact trickle down, and maybe GDX goes there, and GDXJ goes from down here to like same level basically, and they obviously then would outperform from here on out because it's a bigger move for GDXJ. But if the juniors are starting down here, they would outperform even more, right? And if we were talking to like a huge speculative top where it's like, I mean, nobody's really gonna, I assume, pay PE of 100 for Barrick, for example. That would be pricing in a crazy increase in gold price. But some juniors where it's like, hey, some might be pricing in 50% of Blue Sky or something. Where it's like, if and at that gold price, let's say, gold price is at $6,000 in 2 years, and the sentiment is red hot, and you have a junior that's an exploration story. It's like, hey, this could become 5 million ounces. And it's maybe even quite early stage, but it's like 5 million ounces at $6,000 gold. That's worth 7 billion or something. And it trades up to like 3 billion, for example. That's theoretically stuff that could happen because in the, and I've talked about this a lot of time in the, especially bear market, it's potential that get priced in the least but can run the most from bottom to top. Because at the lows, nobody gives a shit about potential. Everything is seen as risky. And one could say that's the case for, inflection. Because what they still have, until they make a actual like discovery hole, on paper they have potential. Shitload of it. But it's potential. That's seen as risk. Because obviously they could miss or they could not find anything. I mean, personally, as my portfolio has felt, Rakla, potential, missed. Phoenix, first 4 holes, I mean, they hit something, but it's like it's not what I was hoping for example. And so I think we're seeing that there's like we're not anywhere close to euphoric. I mean, I think, for example, this is ridiculously cheap. I mean, they're looking for, the case, billion-dollar prices. So I mean, and when the sentiment is bad and people don't want risk, and especially with gold and silver is rocking, it's like, I think, as I've said for a long time, I think early stage grassroots exploration store needs to be really, really good, either extremely cheap or whatever, mind-numbing target or something, to warrant buying that before the banked success, which you could be and still pretty much can, I guess, pick up for quite cheap prices. Risk has already been taken, but you can still buy it for maybe around sunk cost or cheaper than that. But I think this is kind of example where we are, where it's like retail is not really in this sector yet. I don't think. I mean, Bitcoin is taking on water, etc. But I mean, they did a run up, and it's not too long ago. It was at all-time high and all that. And if people ask me, where do you think silver juniors are going to be trading if silver is $67? I would probably have guessed like 200% higher than they are now, just based on what you expect from sentiment. Because you can look at whatever. It's like take BlackRock silver for example. That popped nicely as of Friday, $8 million or 8 million volume even. 365 million CAD. But it's like if you look at their NPV, for example, that's a PA, so it's as often is the case, PAs are a bit too optimistic, but still, I mean, on paper, if they did a feasibility study with $4,300 gold, $67 silver, I mean the NPV is going to be way higher than this. And if I remember correctly, it's like from people who've said it's like in the biggest manias, and I'm not saying I'm preferably will I want to be a holder in at the not the peak but up till the peak of course, but I mean I think it was Jonathan Goodman, and I talked about this before, who said that there was I don't know if it was the 1970s bull or 80s, where it's like, if I remember correctly, he said that gold in the ground was trading for a higher price than gold out of the ground. I mean, that sounds obscene, of course, but assuming I interpreted what he said correctly, and he used that as to show what an extreme bull market environment would be like, extreme hype. So basically, if you had if you had on 1 million ounces of gold attributable to you in a gold junior, and they had it in the ground, and gold was 4,300, you get paid 4,500 per ounce in the ground, and you could buy literal gold for 4,300. I mean, that's obscene, of course, because nowadays, I mean, it's still just $100 per ounce or something. So I mean, it's just sounds absolutely out of this world. But then, of course, that's, I mean, super irrational. Is that an impossibility? Maybe not, but it's like if we get 20% of such a mania, prices would be much higher. So, I mean, what I'm saying, I guess, what I'm trying to explain is that I am not looking for exits anytime soon. If I'm in GDX, who knows? I mean, it's like, yes, if gold goes up, it's gonna be good and all that. Maybe GDXJ as well. But in some of the juniors, I think they're, if some of the juniors, their projects still, and yes, there's a long way from having ounces in the ground to ounces coming out of the ground, but it's like, let's say it costs BlackRock Silver 300 million to build their project, and let's say they at these prices they would make like 300 million per year. Isn't this cheap in that case? So you pay 300 million to put something into production, you earn 300 million per year. Again, I'm just making up numbers now, I don't remember the exact in the PA, and of course they've been drilling more and all that. But it just goes to show. I mean, that doesn't sound expensive, right? I mean, if somebody asks, it's like, hey, give me $100 and for an investment, and then that $100 is going to earn $100 every year for 10 years. That's outrageous, of course, right? My point is, I don't think these juniors, I think they're still cheap. I think they're still pricing in a much lower gold price, but I can't say the same for necessarily GDX. Or maybe even GDXJ. So that's my only compass. I'll sell when I can't find a single cheap company to invest in. And as of now, I think juniors are cheaper than GDX, cheaper than GDXJ. I think they're very cheap. That's why I'm holding them. They might be cheap even if gold goes down to $3,000 or silver goes down to $35. That's margin of safety. And then, of course, if you think, well, I think they can also expand on that value over the next 3 years, then gold and silver prices have to go down more and more over the next 3 years for me to lose money. That's stacking the odds in my favor. That's a hodl approach because the case is actually not tied to where gold and silver is going to go. It's tied to these are cheap now, and until that gap is closed, I'll keep it. And I just have fun sometimes where it's like, play around, because one thing is of course gonna be where let's say your portfolio is growing, let's say your portfolio is getting bigger than it's ever been, and that might create some stress, and I did a tweet recently where it's like nobody can prepare you for the pressure of hodling in a bull market. As your account, on average, let's say every year at least, again, remember that most of the time this sector will spend consolidating even in a bull. This time might be different, but assume plan for the whatever it is. Assume the best, prepare for the worst. And you're seeing it's like, okay, my account is going up, and you're seeing a bunch of green next to some positions, and historically it's like, well, especially, and I added that in the tweet, if you start investing in 2020, you will have even, all you've known is disappointments to 2024 at least, and maybe even early 2025. So if you're used to never seeing green, or anytime you see green, that's going to get erased quickly. You're going to feel a lot more pressure, of course, to actually be able to stay the course. It's like when I think of poker, I talked to someone yesterday about this, where it's like the worst pressure when I played poker was if you started up. If I played 30 minutes and I was up a good amount, let's say up a few buy-ins within 30 minutes, then it became increasingly difficult to keep playing. Because there's no worse feeling, really, than having a win and see it disappear. Psychologically. So, if I was up 30 after 30 minutes or 1 hour, sometimes I just that I got better and better at just staying disciplined and not caring about feelings much at all. But sometimes I would just quit playing because it's like the pressure was too much. Every pot that you lost, where it's like, okay, now those profits you had. Let's say you got lucky or ran good in 3-4 big hands, and you're up 3-4 buy-ins, and you see it getting chipped away. Then you start to fear, well, in an hour or two I might be down to plus minus zero, and the idea of like not quitting and doing more work to see the profits disappear, it's just too much to handle. Whereas like if I was down on a session, I just kept playing, and a lot of poker players say the same. I mean, I've had sessions where I played for probably 10 hours straight, which was only possible because I was trying to claw back a loss. I had nothing to lose, you know what I mean? And I didn't want to go to bed feeling like, okay, I played for 6 hours and lost money. So I did all the work. I concentrated for 6 hours to have less than I had yesterday. So I went to work to lose money. That's not a good feeling. So then I could just keep playing, and probably did maybe even 12-hour sessions sometimes. And when I got back to even, I went to bed. That's just some psychological thing with poker. But let's put because again, it's like as always. I mean, most of this stuff, in my opinion, investing is psychology. And the biggest edges you can have is controlling your own psychology and abusing, I mean, it sounds bad, but abusing the market psychology, which is the marginal investor. Short time frame, can only focus on one thing at any one point in time, and almost, what's the other one? What's the third one? I honestly don't remember. But anyway, so I just, play around with like, okay, I did this a few days ago, just looking at. I put it into ChatGTP and asked it to project some of the economic studies to the spot silver and gold prices. I mean, Amex is expected to be, well, they're planning to go into production in not the too distant future. So that spit out, hey, NPV of Peron, and Peron is probably going to grow and all that, but it's like at 2.5 billion at today's gold price, or $4,000 or 4,300, somewhere along those lines. So assuming then one can say, well, if it's going to be in production and it's worth like that much, if that comes close and gold is in fact at 4,300, if not higher, and we're assuming constant inflation, or let's say gold trends up a bit, but inflation trends up a bit. One could say this is up to 325% undervalued. That doesn't really make me want to jump on the sell button, even though the position is up, 200, 300%. But if I have no idea what this is worth, or have no case, and you're just seeing, it's like, oh, I'm up in this position, and you remember the bear market where every single almost rally got erased, you're gonna be fleeing for the exits. And think about all the people who have said, I don't know if they continue with it, but I don't know how many people said, I can't wait to get back to break even and leave this sector. Why? Also psychological reason, of course. When you're down, it's like playing down in a poker session. You don't want to have done anything for nothing, especially if you're not losing money. So you're like, well, I'm gonna have regret. And the only way to get rid of regret is if this doesn't look like a quote mistake. So if I sell, when I get back to even, I didn't lose money, right? So I don't have regret. It's like the decision. My ego won't treat it as a bad decision all the time. Well, in a sense, you know what I mean. There's like, I didn't do something and then gonna feel shit about it because I lost money. Because at least I get out with break even. Plus, if I get out, I don't have any anxiety anymore. So I limit the regret and get rid of the anxiety from being in the sector. Makes perfect sense. And of course, that's why, the market will if you let the market break your mind, you have no shot, not in a volatile sector like this at least. Honestly, it's like, just speaking for myself, I mean, I do treat it kind of as a game, and it's like in poker, you didn't look at the chips necessarily as money, it was just tools. And on that note, I had an easier time playing for more money if I played on American sites where it was US dollars, because US dollars is 1/10 of the. I mean, it's like if you're playing with 1,000 Swedish kroner on the dollar tables, it was just $100, so it felt less. So it felt less real. It felt like I wasn't playing with the same amount of money. So then you can gamble, gamble. Well, I honestly think I did gamble more as well. I took it more seriously when I felt like it was actually real money. I was more disciplined. But the point is that I'm not that materialistic. I don't do much with my money. I should actually do something, but so it doesn't bother me that much. I don't have like, oh, I want to buy a whatever it might be. Oh, I lost a Lambo today, and that upsets me. It's like, no, it doesn't. It doesn't change my I'm not. Yeah, I don't know how to explain, but it's like I don't. In one sense, I don't care about money. I mean, I read an article. I think I posted it on the website about Warren Buffett, where it's like he just enjoyed the game. He wanted to compound. He wanted to compound. That was the most fun he had, compounding. It's not like he needed the extra 100 billion or did something different, or I mean, I think he drove a pretty shitty car, lived in the same house forever, and and still does to this day. So in a sense, he had nothing to lose, really, or gain. He just wanted to beat the game. But if money is that maybe important for you, you really need the money, you're gonna make a bunch of mistakes. But anyways, like I would urge anybody to whatever case you have is like reevaluate. Let's say it's up 100% or something. Should you be selling it? Maybe you should, maybe you shouldn't. And of course, as the sector revalues, the risk reward is going to decrease and the opportunity gap is going to close. So I mean, if a year ago there was a bunch of like easy, obvious 300% returners, it's like they're all trading for $1. You think they're worth $4, and now they're up to $2. So it's like that's obviously less obvious upside. Then it's like you're waiting for a quote easy double from here on out. But maybe all of the cases you can find, that's what you're left with. So it used to be a bunch of easy quadruplers. Now it's down to easy doublers. Yes, less for your money. $1 invested today is gonna have less expected returns than $1 invested a year ago. But still, if it's quote easy doubler, that's still a really good return if you assume it's going to come within 2 years or something. So that doesn't mean sell. It's just not as good of buys as before. But if you can find some gem or some, that's why I keep talking about this sector is going to get really hard when prices are high. I'm much more comfortable buying in a shitty sentiment because then you kind of know. I mean, it's like 2024, it was almost impossible to overpay for anything out of quality. And lo and behold, all of that is higher than it was at the bottoms, etc. What else? Was there anything else I was gonna go through? Well, let's just look at. I mean, BHP, for example, looks like it's forming some fat veg. The same with Rio Tinto, and I talked about this last video. I think interestingly, I've just been thinking about okay, what sentiment sucks. Well, oil and gas absolutely sucks, and I've seen like people talk much record shorts, and of course we've seen articles about the surplus in oil, the oil glut, yada yada. So it's like headlines suck ass, oil price suck ass, and you're thinking, well, why get into oil? And then you listen to recruiters like, well, oil and gas is so hated that I think this is going to do well on a few years. So I mean, basically what he says, and this kind of goes back to his modus operandi, but also the mining sector from 2000 or 2015 or 24 or whatever you want to or whatever bottom you want to look at. It's like you kind of know, regardless how shit it is, because 2015 the sector was shit. No mine was making money. 2020 actually mines were making money, but the sentiment was still shit in juniors. They were at like 2015 bottom levels, and okay, let's say 2015 instead. Sentiment was shit, gold silver prices were shit, everything was shit. So it's not like you were buying, well, this is so cheap, and that's why I keep saying that 2020 was much easier to buy than 2015. Jesus Christ. 2024 gold was still at, I don't know, 2,000, 2,500, 3,000, and you could be buying the stuff like gold was 1,700. In 2015, that was a proper bottom. That was a proper bear market because gold and silver was shit. No project made sense. So you were buying stuff that you literally had to be a contrarian to buy because, hey, this project is worth nothing at these gold prices, so prices have to go up. So if you couldn't buy 2024, I don't know how anybody would be fool themselves into believing they would buy 2015. But anyway, more to the point, that that the simple idea was that, well, or let's say oil and gas now, if we're thinking recruit, maybe everything is so shit and it's priced like everything is shit that the next obvious move is to the upside. The next big delta can only possibly be to the upside. You know what I mean? So I've at least been looking at some gold and oil and gas plays. but the thing is, like, it's not my cup of tea really. I don't know much about oil and gas, so we're talking like minuscule position in that case. But I looked into Tourmaline Oil Corp because they showed up on SEDI that they had insider buying, and I remember so lot of insider buying around these levels, and I looked at it for a long time but never actually bought. Then it jumped higher. Now it's forming a big fat veg again. And of course, you can say it's like, well, look at this chart. Does this look like, depressed sentiment? Everything sucks. No, not. I mean, not if you look at the price level here. It went from 60. It's 10 bagged. But at the same time, I have no idea what the company's done. Maybe it's worth 10 times more. Maybe they have created 10 times the value. Maybe this is actually cheap as chips. Maybe this is as cheap as it was down here, for example. I don't know. Anyway, it's like uh, even though I don't necessarily see myself as a contrarian, because buying cheap doesn't feel like you're contrarian, and I haven't needed to be contrarian quite some time. That's like 2015 bottom, where yes, literally, you bought something that was at face value worthless, and you had to have something go right with the gold price of gold and silver. But at least you know where the big move was going to be, and that was an epic rally coming out of 2016. So, what am I trying to say with this? I don't know. I mean, it looks like the major miners preparing for a big move. This oil company is preparing for a big move. Which way? I don't know. But if this is super cheap, it's like I wouldn't pay too much heed to the shit sentiment or the shitty headlines, because if this is rock bottom cheap, the big the probability of the next big move being up is much better than the next big move being down, right? If it's just dirt cheap. And I'll try to run through. I was just gonna look at, for example, one hodl folio. So here are some hodl cases that have so far performed well. Uh, and the idea is that, again, it's like, what was I gonna say? Oh, actually, I missed a bunch of. Oh, I have a bunch of additional points. Well, actually, I might do a two-part video of this. Okay, I'm gonna probably cut it here and then do another one. Uh, as always, thanks for listening. Not investing advice. If I talk about any miners or any stock, assume I own it. Some might be banner sponsors, twice biased. Again, not buy or sell recommendations. Don't invest money you cannot afford to lose. Assume any stock I talk about. Assume, or I should say, if you're afraid of being my exit liquidity, aka pump and dump, don't buy it. It's like the ball is in your court. You're responsible for your own portfolio. Thanks for listening. Bye.